Hello and welcome to the Wire Business Report. I'm Mitali Mukherjee. As the stock market turns a corner into Samvat 2075, it's always been considered an extremely auspicious time for traders and investors. A chance of sorts to turn the page on what's hopefully been a chapter of fruitful returns and look forward to the promise of more. But Samvat 2074 may well be a year investors would want to forget quickly. Let's take a look at what this year has meant for a small investor. Someone who's setting aside, with some difficulty, a little piece of their earnings for a rainy day. And as the PMC episode has taught us all, there can be many rainy days. Ailing parents, tuition fees, a wedding. Suddenly, the system has suffered a shock. Fixed deposits that were once considered the safest haven, as also the bane of the equity market's existence, suddenly seem not that safe anymore. PMC has taught people that they can be unceremoniously locked out of access to their own money. Added to that, there's a second googly in the FD universe. The RBI has introduced a repo-linked lending rate regime. Basically, what that means is that there's quarterly adjustment of the fixed deposit rate. Now, how does that affect a small investor? It means that those investing in fixed deposits, especially senior citizens who are mainly dependent on the interest income from that deposit, are likely to see a reduction in their income. In fact, with successive cuts in the repo rate from the start of the year to now, banks have actually been reducing interest rates on FDs for several months now. SBI has already reduced its FD rates thrice since August. Currently, the interest rate on SBI's one-year FD is 6.5%. In fact, for SBI customers, it's not just bad news on the FD front. The bank may even reduce the interest rate on savings accounts with balances above 1 lakh rupees.
Most of India, because we don't have social security, depends on bank interest. Especially senior citizens, they depend on bank interest in order to spend their retired lives. And therefore, for them, if you have an external benchmark and you don't know whether you're going to get 7,000 this month or 3,000 this month, how on earth will you, even budget for your expenses? And actually, de facto, the bank interests are the ones that act as the social security net in our country.
So, if we strike FDs off the list, we move to bonds. The AAA corporate debt space that was considered Teflon coated is suddenly getting jolted. Blow-ups big and small in names like Z Entertainment, IL&FS, Reliance Capital, Reliance Infra have caused huge flux in the bond universe, and debt fund NAVs are eroding because of exposure to real estate and other corporate debt. There is a trust crisis. Although the chase for yields had started earlier, fund industry officials say it intensified some time after demonetization. In November 2016, after the Government of India banned high-value currency notes, people deposited large sums of money in banks, which later got invested in financial instruments, just like the mutual funds. While investors poured funds into equity schemes through SIPs or systematic investment plans, they were also parking sums in debt funds as alternatives to that bank FD. In 2017, for example, debt funds actually saw a net inflow of over 42,000 crores. But that's changed a lot. The proof is in the numbers. SIP inflows have stabilized, but disenchantment towards SIPs in the past few months is being reflected, both in terms of new SIP registrations as well as in the number of discontinuations. The fixed income category actually saw outflows of over 1.5 lakh crores in September. Liquid funds saw outflows of 1.4 lakh crores in September. From the equity universe, while Samvat closes with gains of between 10 to 11% for the frontline indices, it's not been that pretty for the small cap universe. And that's the space that was hugely popular with small investors. The BSE small cap index is down more than 10% Diwali to Diwali. The small cap funds category has fallen by about 17% on an average in the same period. Remember, this is a space where small investors put in quite a bit of cash via SIPs, etc., and they've been singed badly this Samvat. But what stands out is the callousness. For instance, nearly a month after the RBI clamped down on operations of scam-hit PMC Bank, depositors say their woes have only worsened. People have lost their lives, parents are unable to pay the school fees of their wards, others are finding it difficult to meet medical expenses. Could there have been a fairer resolution for the depositors? Couldn't the government have compensated the financial needs for the depositors? The pain of the small investor is only his or hers to nurse this Diwali. At the start of the year, economists, policymakers, corporates knew it was going to be a stormy year for growth. But the months ahead proved just how bad things were about to get. In the last fortnight or so, growth downgrades have been pelting down on us, some more vocal in their sour outlook for India's economy. The key parameter of any economy, its very heartbeat, is growth targets. By the RBI's own admission, growth is sliding towards the 6% mark. Ditto for the World Bank, IMF, the Asian Development Bank. In fact, Moody's has said it's looking more likely that India will make it to a sub 6% tick on growth this year. Moody's has not just set growth at a paltry 5.8%, they're saying one of the major reasons for a dip is financial stress among rural households and weak job creation. None of this is unexpected. None of it is a surprise with what the auto sales, earnings trip-ups and bad loan after bad loan spelled out. What is worrying and disturbing is the quality of this growth erosion. It's hitting predictably the pocket where it hurts the most. People are indeed slicing back on spending. FMCG rural growth has slumped to a 7-year low. North India, which is the largest market for FMCG, saw volume growth grind down to 1%. 1%. But here's what really hits out. Mahesh Vyas of CMIE says rural unemployment has actually risen through October. The rural unemployment rate in the week ended October 6th was 8.3% and in the second week it was 8.2%. This after having remained well below that 8% mark in each of the 4 weeks of September. And the other engine is sputtering too. Industrial growth shrank 1.1% in August after a gap of 26 months. In fact, IIP growth has been the lowest in the last 81 months and is the first contraction after June 2017. Even as economic data continues to disappoint and dismay, the politics of cross-border conflict and an imperceptible yet steady stream of bubbling communal tension seems to continually distract from these economic figures. A key fear over the next few months will be the possibility of large-scale unrest and violence amongst labour unions that have been struggling both with plant shutdowns, reduced workdays, wages and in many cases job losses as well. The hard road, it seems, is nowhere near its end.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.